Hello everyone, further in our series Insights from Insiders. Today we have Ameya with us, who is a fundamental crypto investor. So welcome Ameya, great to have you at Valuationary.
Thank you so much, Naren. It's great to be here.
Alright, so without further ado, let us start with the interview. Let us start with the basic most question. For the uninitiated, can you explain what are cryptocurrencies and how did they originate? Also, what according to you are the reasons for their massive adoption in recent years?
Okay, so I'll give you a very simple example to understand what cryptocurrencies are and what is the origin of these currencies, right? So in our day-to-day lives, if you want to buy something, we go to a shop, we pick up the product and we give our card, for example, to the customer, to the shop, right? So what happens after that is shop takes our card and it basically makes a request to the bank to verify if I have enough money to cover for the payment, right? So bank checks its record and sends a reply whether I have enough money or not. And then based on that reply, shop gives me the stuff. Right? So if I buy something, bank also makes another entry in the ledger that reduces the balance in my account to adjust for the purchase. Bank makes one more entry that represents the movement of money from my account to the shop's account. And bank earns a processing fee. So if there is a payment gateway involved, then they get a cut based on a transaction value. So this is how things work in our everyday life, right? So basically what bank brings to the table is the trust. But that trust is not immutable, meaning there are ways to double spend the money or hack into accounts or spend the money illegally, transfer the money illegally. So to eliminate this risk, whom should I trust? I will not trust you. I will not trust the person sitting beside you or person sitting next to me. But probably if everybody has the same version of truth, then I will trust everybody. Yeah. So it's a binary. I will not trust any individual, but I'll trust everybody. That everyone is nothing but a validator on the blockchain who ensures that no fraud is taking place, no records are changed, and the chain of transaction remain immutable forever. And for doing this, I get a certain reward because I'm doing a work, I'm doing a hard work, so I get a reward. That reward is an on-chain issuance. And these are all blockchain terminologies. And that on-chain issuance is a token. And that's what people call cryptocurrencies. These are the rewards given by the underlying platform to its validators for keeping the network secure and keeping it functional. Coming to the massive adoption point, I don't think the adoption has reached the scale where we can call it a massive. Okay? Probably speculation, perhaps, is at massive level. Every day, if you're following social media and this space closely, you would see how NFTs are, breaking through the roof every single day. The bidding process is just, getting at insane level each day. So probably I would say the speculation is at massive level, but the level of adoption is still in its infancy. But the rate of adoption is increasing day by day. If you look around, there are many institutions who are adopting this technology to protect to solve the piracy issues or to trial run their digital currencies that they want to launch in their own nations. The countries are doing pilot on top of these platforms. So the adoption is rising, but it's still not at massive level. Definitely, we are at very, very infancy kind of a level.
All right. So as you talked about trust, how effective do you think can cryptocurrencies be in solving the problem of trust in low trust nations like India? And in what ways can they potentially do that?
Yeah, it's a good question. I think the technology itself, the blockchain technology itself, has a great potential to solve many issues that we see in our lives in India. I think it is safe to say that banks and regulators or the entities who basically play the middleman, they are in the business of trust. So these entities guarantee that a transaction will be fair and safe. So that's why people like you and me pay transaction fee in exchange of that trust, right? So this trust, like we discussed earlier, has been put to test many times. Like frauds are committed by large corporate promoters. Is a direct contradiction of that trust itself. Right? So if that trust is so immutable, why there are so many frauds all around, right? So that question comes to our mind. So that means the trust that these entities bring to the table is not immutable. So I'm sure you must remember this instance of Curvy broking misusing clients' securities to fund his real estate arm, right? So that is also one of the instances which is very fresh in our mind. So the point is, whenever there is a middleman, corruption is kind of inevitable. It's unfortunate, but it's inevitable. And the adoption of blockchain can solve this problem. Not the cryptocurrencies, but the technology itself has a tremendous potential to solve this problem. We already have, if you talk about banking and the financial as a domain, we already have a consortium of Indian banks adopting a blockchain, and it's called as IBBIC. What they are doing is they are creating a platform to issue and settle letter of credits, since the double credit spend and the fraud around this area is very common. And this consortium platform can literally revolutionize how banks do business. We can issue driving license on the blockchain. Education certifications can be issued and validated on the blockchain. Since you are also studying out of India, you must have seen this trouble around getting your transcripts in a sealed envelope from your university and sending it to another university, and the foreign university then tries to grade your degree on their educational levels, right? Whether it's valid, it can be accepted or not. So all these certificates, they can be put on a single blockchain, and these are immutable. And then you don't really have to go to your college or university asking for a transcript, or the foreign university doesn't have to go and validate your degree certificates. So land ownership records, payments, banking, money exchange, contract settlements of any nature can be done on the blockchain. The decentralized exchanges that are currently running only exclusively in the crypto space, that also have a tremendous potential. So these exchanges do not require any settlement and or clearance entity, like we have CDSL and NSDL in India, right? So NSE or BSE basically can adopt such technology, and they can issue contract notes on blockchain. So there will be never any problem of stocks not being available in your demat allocation, or there is an order mismatch. For example, if you buy 100 shares of Infosys, but the delivery never happened because the seller did not have 100 shares of Infosys in his or her demat allocation. So all these kinds of problems will never happen. And just to sum it up, I think India can literally transform if blockchain is adopted aggressively. We need open policies, we need accommodative stance. And if you're concerned about only cryptocurrencies and issues around it, then you must look around and ask yourself, don't we have frauds or money laundering or illegal payment issues around traceability of cash with the fiat money? We do, right? So we don't want any nation to adopt cryptocurrency and replace the native fiat. We don't want that. But India can launch its own crypto token, for example. Let's call it an INRC, just for an example. And you can peg it to the INR, call it a stable coin, and you ensure that all the transactions are paired with this coin alone, just like you do in a foreign exchange. You can't, for example, if you are living in India, you can't trade in USD Euro pair. You can always trade in INR USD, INR UR. So that ensures that traders don't get undue advantage by selling Indian rupee and indirectly kind of weakening it because they're selling Indian rupee, right? In order to buy another currency and then trade into it. So I think in a low trust nation like India, I think that the scope is tremendous, and India can be actually a playground or a backyard for doing all sorts of trials all around, because the sheer number of population that we have and the nature of businesses that we have, I think the potential is tremendous.
All right. As we talked about blockchain technology, it is an integral part of every cryptocurrency. So zero knowledge proof as a concept looks very promising for blockchain technology. However, it is difficult to grasp. How would you explain this concept to a 12-year-old child?
Okay, so zero knowledge proof, or ZKP as we abbreviate it, it's a relatively new concept in blockchain. It's not necessarily a blockchain per se concept. It's a crypto encryption concept, basically. Okay. So for example, let's say you are a teenage girl and I want to know if you have a secret. And I want you to prove it to me that you know the secret without telling me what the secret is. Did I make it too confusing? So basically, that's what zero knowledge proof is. For example, let's take one more example. Let's say you and I are in the park and there are two birds sitting on a branch of a tree. Okay? You are colorblind, but I'm not. And how will I prove it to you that both birds are of not the same color? So if I can prove it to you, since you are colorblind, you can't really understand and differentiate yourself. What is the way that I will take in order to explain it to you honestly without lying? That's basically what lies at the heart of zero knowledge proof. Let's take one more example, because zero knowledge proof is something that you have to understand through examples. If you go and talk in a technical language, you'll probably say, nah, that's not for me. Okay. So let's take one more example. So you are looking to buy, let's say you are a real estate investor and you want to buy, let's say, a couple of properties, and you come to me and I tell you, hey, Donel, I have a few apartments in the building. I own this entire building and I have a few apartments in this building. And you ask me, how do I know that you own the apartment? And you're not really selling someone else's apartment to me, right? So I tell you that, okay, the only way that I can prove it to you is I know the 4-digit key lock to the apartment and it's given only to owners. So nobody else knows it. And you want to buy a few apartments there, but you don't trust me. How will you verify that I am speaking truth and I'm not lying? Here is how. So you ask me to enter building from the entrance where you are not standing, from any other entrance, okay? Then you randomly ask me to open the door of any apartment without telling you the code. So you will stand in front of the building and you'll ask me, Amay, open that door, open this door, okay? And I open the door, but you think, probably Amay just was plain lucky. He somehow managed to get a code and he opened the door. I still don't trust him. So you ask me to open the doors of 10, 20, 30 more apartments. And each time I open the door on the first try. So the probability of me lying reduces significantly as you ask me to open more doors, right? So this way I can prove it to you that I know the 4-digit code to each apartment. And indeed I'm speaking the truth, but I'm not telling you the code. That's basically what zero knowledge proof is.
All right, very, very well explained. So moving on, what potential does blockchain as a technology hold in various sectors like education, healthcare, and lending, etc.?
Right. So basically, I think we can get rid of the middleman who is prone to corruption or tampering. That's what the core thesis is. Take any example, let's say vegetable or fruit supply chain. And if you are a farmer, you have extremely limited options to sell your produce. Of course, the situation is changing. I'm not really updated on that front. So you have to cut me some slack when I give these examples. So you go to APMCs to sell your product, where middleman takes most of the cut and dictate what you sell and at what price, right? So there are deviations for the prices for the same produce or a same product if you go from one state to the another state, right? So subsidy management is one more area where government can launch smart contracts on blockchain, and literally everyone operating businesses around it will be forced to follow the rules. As simple as that. Education certificates, we already talked about it. Like education certificates can be used as smart contracts in blockchain. So can the health records, for example, not just lending, but every function around banking and finance is up to be disrupted by blockchain. So payments, clearance, settlements, fundraising, security issuance, loan, interest rate products, trade finance, KYC, investment without a broker, loan without a bank, or insurance without an underwriter. I can go on. So basically, I think the potential is tremendous. Uh, what we need more entrepreneurs adopting these platforms. But right now, unfortunately, since government stance on cryptocurrencies is still not clear, startups are not really that open and aggressively adopting this platform. Because if you say, for example, if you want to launch a kind of, let's say, interest rate protocol, okay, so you would most probably work with a protocol provider called as Atom or Cosmos, and then you adopt Ethereum to settle, just for an example. But when you do that, you have to buy the initial set of tokens yourself, because you would be settling on those chains. You need to pay the transaction fee, or what we call as a gas fee, on those platforms. So unless you buy the tokens and pay the gas fee or the transaction fees in the native token of those blockchains, you really can't have a functioning product. Okay. And what government needs to do here is they should clear the stance as soon as possible, and they should make it, if they can regulate, if they want, regulate, jitna bhi regulate karna hai karo. But the point is, don't try to tone down the potential of the technology. That's what basically what we need.
Okay. Recently, we have seen willingness in companies across the globe to accept cryptocurrencies in their dealings. Do you see this as a short-term trend or a fundamental change in the way transactions work?
I think there is a fundamental shift. Banks and financial institutions are always hungry for yield. And the nature of yield crypto currently offers is next to none. So that's one reason. Another reason is institutions don't want to miss out the emerging asset class. And the yields in decentralized finance protocols and solutions, certain protocols such as Compound offer, are really next to none. So eventually the yield will come down, but the adoption will is increase. So it's a win-win situation for everyone. And coming to a very specific point where we see companies are accepting payments in crypto is a whole different topic here. I mean, I can understand if they have a stable coin pegged strategy that allows such companies to realize the price as close to a US dollar as possible, right? But otherwise, the volatility in crypto is just too much at the moment to call them a legal tender of exchange. So this space is still evolving, and I think there are a couple of reasons. One is the high yield. Another one is corporates really don't want to miss out on the technology adoption and technology revolution. If you know already that Infosys is already one of the early validators on the Polygon network. They did not do that to earn a yield. They did not do that in order to launch a product on a cryptocurrency, but they wanted to ensure that they learn the technology and scale practices as the network grows and develops. So I think there are such different interest areas for corporates to adopt cryptocurrencies. In India, that adoption is very, very low. TCS and Tech Mahindra have launched certain products, but nobody has actually bought a cryptocurrency on book. Like in US, there are so many companies who own Bitcoin and other cryptocurrencies in their books. We don't have anything like that happening in India yet. So that's why I think it's not a temporary shift, it's a fundamental shift in my opinion.
Talking about India, a lot of people feel that UPI has facilitated fast and efficient transactions for people. So what incremental benefits does cryptocurrency provide for the common man in particular?
Yeah, I think UPI is a world-class platform. It is better than most blockchain-based payment applications, to be really honest with you. If you look at the number of transactions that Bitcoin currently settles, or number of transactions Ethereum currently settles, and then you compare with the number of transactions UPI is currently settling, you would clearly see that blockchain is not a panacea, one solution fits all kind of a thing. Okay. So I think UPI is a world-class platform, but UPI is only for payments as of now. What UPI could do in payments can be done in many different areas where blockchain can bring in a lot of efficiency, right? For example, I'll give you my example. I use a Forex remittance service called TransferWise. On weekdays, money arrives within seconds, no problem. But on Friday and weekends, it takes nearly 36 hours for money to be credited in my Indian account. So blockchain-based payment process apps can solve this problem. But there is a technological challenge. UPI or Visa can handle really large number of transactions at the moment, but crypto is not suited to handle those many transactions just yet. It's still a developing technology. But some platforms, for example, Ripple or Ethereum or Solana, they are really promising, and these can bring in efficiencies without losing of volume. And one big area where blockchain can really help is the privacy and the data protection. We already talked about what zero knowledge proofs are. So ZKP based authentication has tremendous potential to get rid of identity theft and privacy breach or hacks, for example. And what it means is we can get rid of the problem of a login system for any website. So if you, today, I'm sure I'm not the only person who has account with, let's say, hundreds of different websites, and I have different user IDs, different passwords. There are some people who are very new to technology, complete technology as such, and they have same password for all the websites, and they are prone to hack. But then there are people like you and me who are literally, a little bit technologically advanced. What we say is, no, we don't want same password for every website, but then remembering it becomes very difficult. Then you start using this browser-based tool to remember your passwords, and then you have password generators. But eventually, it just complicates the scene. And when you're creating an account with a website, literally you're giving your everything to them. You are giving your age, you are giving your gender, you are also giving your date of birth, your PAN card number, your Aadhaar card number, passport number. If you want to open an account with a Binance or a Coinbase, you also have to give your residence permit. So basically, they also get your photo, and just to recover the account, if at all you forget the password, they are forcing you to set some security questions, which is again furthermore private information, like what's the pet name of the pet, or what's your mother's maiden name, what was your school name, where were you born, what is the make of a car. So you see, the trade-off is not fair. If you want to open an account at Amazon, it literally owns your identity, right? So the zero knowledge proof based login can literally eliminate this complete trust and privacy and data security issues. I think there are many projects that help track, maintain, and secure patient records. So whenever you go to a doctor for a diagnosis, just for as an example, or a second opinion, and the doctor asks you to perform tests again, and it's very common scenario in India. Okay, every doctor wants to conduct his or her own tests, and this leads to delay in the treatment and unnecessary expenses for patient. So decentralized patient record can help everything. The doctors can make faster diagnosis, hospitals can reduce resource wastage, labs can avoid multiple sample processing, and insurance companies can settle claims in real time, right? So I think what UPI has done for payments is really fantastic, and to be very honest with you, no blockchain platform can match that yet. But what we need is more similar solutions in different areas, different businesses, and I think only blockchain has that potential as of now, unless we have a UPI for stock market or UPI for document verification and so on.
All right. Talking about Ethereum is switching from an infinite supply to a deflationary token. What would have been the reason for such a move, and what impact it would have on the ecosystem?
Yeah. So one thing which is very important to understand is Ethereum is not yet deflationary. So there are two things happening in Ethereum as of now. One, which already happened on 4th of August, is the Ethereum Improvement Protocol, which we call as EIP 1559, or Ethereum Improvement Proposal, right? So that was done for a different reason. And then there is a proof of stake merge or a chain merge, which will happen at the end of the year. So these two events combined, they will make Ethereum deflationary. So Ethereum is not deflationary yet. So if I have to explain this further, the major problem with Ethereum was the unpredictability of the gas fee. Gas fee is nothing but a transaction fee that you pay to the validators in order to get your transaction done. And for example, if you want to perform a transaction on Ethereum, you are presented with 3 choices of gas fee, and that would be slow, standard, and fast. So it's just like Ola or Uber. When you are in the market, peak of the rush hour, and it's raining, demand is sky high, and you see the rates are at peak as well, right? The Uber and Ola charges are at peak when it's raining and the situation is really difficult getting an auto or a public transport. So similarly, when there are more people executing on Ethereum, the gas fee was really unpredictable. And this was mainly because the miners, since Ethereum is still a proof of work, hence I'm saying this term as miners, not validators, because miners is a proof of work terminology and validators is proof of stake terminology. So the miners would take in the transactions with the highest gas fee to process first. It's just like you are an Ola cab driver. You would take a passenger who is willing to pay you an inflated rate. If I am willing to pay 100 and you are next to me, you are willing to pay me 150, I'll take you, I'll not take another person who is willing to pay me 100. So miners or cab drivers in this example had a control over which transaction is taken in on the chain and processed. So that's not fair for anybody. So only miners are making money. So why will the adoption of Ethereum scale exponentially if it's not fair to its end users, right? So this exactly what EIP 1559 solved. It brought a predictability in the gas fee that you and I will pay, right? So EIP 1559 brings the predictability in the model and increases the block size. So it does this by splitting the gas fee into 2 segments. So earlier you used to pay your gas fee as a whole, but now there are 2 components to it. So one is a base fee and another is the tip. So tip is like just additional money that you would pay for some value added service. So miners can keep the 100% of the tip as their income. But the base fee, which was earlier used to go in pockets of miners, making them rich, and end user was left in pain high and dry. Now that base fee is entirely burned. Now, since the fee is still paid in Ethereum denomination, it represents a burn of on-chain issuance. What I mean is, with EIP 1559, Ethereum just got a cap of 119 million tokens, but it is not deflationary yet. It had an infinite supply, now it got a cap. Once a proof of stake merge is implemented at the end of this year, that's really when Ethereum truly goes deflationary.
All right. There are so many different cryptocurrencies, Bitcoin, Ethereum, and so on. So what are the ways in which one can value a cryptocurrency relative to some other cryptocurrency? And what are the fundamental levers that drive its price? Is it network effects or mere speculation?
Yeah, so there are multiple aspects here. First of all, the old school valuation metrics that people try to apply, like free cash flow and so on, these metrics aren't going to help much when it comes to valuing a cryptocurrency. Old school doesn't work in this instance. So to answer your question, how to value one cryptocurrency against another cryptocurrency. So first of all, we have to understand that we are comparing apple for apple. We are not comparing apple and oranges, right? So for example, if I give you a cement company and on the other hand, I give you an asset light platform business, for example, or an IT business, and I tell you, okay, these are the 2 businesses. How do I value these 2 businesses differently? So you will come and tell me, hey, because these 2 businesses operate in 2 different domains, they have different metrics. So the price per ton is what you value your cement business, for example. And in case of IT, you have very different parameters to judge that business. Correct? So similarly, in cryptocurrencies also, we have this. So if you look at a cryptocurrency as a whole package, there are protocol level token, there are L1, L2 tokens, and it's important to understand what L1, L2 is. So I'm calling a cement business an IT business, and I'm just taking that analogy and calling it an L1 business and an L2 business. You have stable coins, you have utility tokens, and then you have governance tokens. So you should not be comparing and trying to value a security token against a stable coin. Because what stablecoin does is it provides it's stablecoin is in reality is a store of a value, because it tries to keep the value of that stablecoin close to $1 as much as possible. So if you're trying to value a stable coin like USDC with a coin like, let's say, Dogecoin, you have got your first step wrong. Okay. So what you really need to understand is what is the layer that token belongs to. So there are two layers, primarily layer 1 and layer 2. And then you compare layer 1 token with layer 1 tokens. For example, if you are comparing Ethereum, compare that with Bitcoin or Litecoin. Don't try to compare it with, let's say, Unify or Doge, for example. So you must compare L1 token with L2 tokens. So that's the first step to get it correct. Otherwise, the start itself is wrong. And there are very simple and straightforward metrics. So first one is the total value locked, or TVL as we abbreviate, and many people know it now. So when a blockchain platform is launched, people adopt it and launch applications on top of it. And when they launch applications, they adopt the native token of the underlying platform for the transactions. And also, people who hold the tokens, they eventually stake those tokens to earn a yield. For example, in decentralized finance, or DeFi as we know it, is an extension of a blockchain technology, and Ethereum dominates the DeFi application ecosystem. Back in May 2021, about $90 billion worth money was locked in DeFi application ecosystem. And as we are speaking right now, it's probably crossing $130 billion total stake. So the higher the TVL, the better the platform, and the bigger will be the network effect. So if there is no enough money locked in the platform, not many people will want to adopt it. What it means is the more people are adopting it, adoption can be easily understood by looking at what is the TVL value. If the TVL value is rising, that means more people are adopting. That means the network effect is eventually going up. And this simple metric can be tracked very easily. Investors can use platforms like CryptoQuant, for example, to find these details in real time. So I think this is one single metric that people can start monitoring in order to understand, okay, whether the network effect is genuinely kicking in or not. If the total value locked is falling down, that means somehow your network has hit a peak. Talking about fundamental levels, I think crypto is perhaps only space where most of the ownership was with the initial developers or early adopters. Okay, so the government institutions or entities, they neither had any major understanding on how to evaluate crypto, nor had any intent to buy it a few years ago. So you can say that the price thus far was an outcome of a few big people, and we call them whales. In crypto terminology, we call them whales. These are people with a very big wallet, right? So these whales used to control the supply. They still control the supply. So speculation is the primary reason so far for the price appreciation. But things are changing, and with banks adopting Ethereum to settle and countries piloting their digital currencies, I think network effect and adoption is set to go up, and the prices in the future will be driven by these two aspects.
When it comes to investing, what would you suggest to an investor who is wishing to allocate certain portion of their portfolio to cryptocurrencies? Can you please highlight certain allocation strategies?
Yeah, sure. I mean, there is no straight binary answer to that. Buy this, don't buy that, because again, it's not right. That's not what we want to do. I think it really depends on how much this area one understands. If you are someone who understands nothing around the technology, and you are risk averse, you better not allocate anything to crypto. But I encourage everyone to read, learn, and understand the nature of revolution that is staring at us. And it's really big. The more you read, the more you understand, and then it makes sense to talk about allocation. So about 15% of my total capital is currently allocated to crypto, and I hold only 3 tokens. And basically, I would say invest money that you will not mind writing off. And when you have skin in the game, you take more effort to learn and understand. You can start as low as you can for the sake of understanding this space. For example, if you buy 100 Matic tokens, that would cost you not more than $130, $140 at max. That's about 10 or 11,000 in Indian rupees. So if you buy it, you will then go on to understand what is Matic. You will find that it is an L2 scaling solution for Ethereum. Then you would like to understand, okay, what is L2? If there is L2, what is L1? Why Ethereum needs a scaling solution, and so on. So you will develop that inquisitive mind and approach towards understanding the technology, and this is how you will develop understanding in this space. So I think there is no straightforward black and white allocation strategy really. It really depends on how much you understand this technology, how much you understand the scale. If you ask me, I'm a very firm believer in the protocol, Ethereum as a protocol, not Ethereum as a token, and Ethereum as a lever to bring the decentralization in most efficient way. So that's why naturally I'm biased towards it. But if you go to social media, there will be people talking about how this platform is better than other platform. It's just like stock market. So even before we think about allocation, I think it's important to understand the technology first and what problem is it trying to solve. There are narratives set and spread every single day. So nobody should trust in my allocation strategy or your allocation strategy. You should look around, understand yourself, try to understand the technology, and then make a small allocation to learn it. So I think that would be the right approach. There is not a no black and white allocation strategy. Sorry to disappoint, but unfortunately, that's how it is.
All right. So the next question is, the creator economy has been poised to grow by leaps and bounds over the coming decades. Against this backdrop, how do you think NFTs can reorient the space?
Very interesting question now, NFTs. So unlocking the value in pockets that wasn't possible earlier is what NFT has done for us. So if I were to explain you what is NFT, I would say that NFT is a mechanism through which I am unlocking a value of a digital spread of my work. As simple as that. So NFTs are not only these cyberpunks or penguins or apes, these kind of collectibles. So if you are following OpenSea, you would see all these artworks getting listed there. So NFTs are everywhere. So you can launch an original soundtrack, OST as we call it, on NFT. You can have domain names on NFT. You can have trading cards, baseball cards, collectible cards on NFT. You can launch official merchandise as well on NFTs. So what NFT does is it allows the creator of the artwork or anything, not necessarily artwork or anything that is creative work, to unlock the value from the digital spread of that work. If you are an artist who often struggle to collect royalties from your song, there are so many people, so many creators, they have one song success, for example, or one painting success, and then nobody remembers them, but people still love their song. I still remember that one song from Sukhbir. So that's a Punjabi song. So I never saw him launch more albums. But even if you play that song today in a wedding, people would immediately stand and start dancing. So the digital spread of that song is so tremendous. People may not know his name, but everybody knows when I say, oh, which song I'm actually humming. Everybody remembers it, right? So how, if you imagine if that artist is able to launch that song as an NFT and collect royalty every single time it is officially played by a radio or by an institution or by a DJ, because DJs play all real songs, they don't play pirated songs, right? So what I'm trying to say is, if you're an artist who often struggle to collect royalties from your song or your work, you can sell your work as an NFT with a royalty built in the smart contract while you sell it. So royalty is built in a contract itself. So every time someone uses the song, you receive a payment in your crypto wallet automatically without asking anyone. I think digital artists have finally found the pot of gold that they're looking for since ages, and But we have to be careful here. Not every NFT is valuable. If you're an investor, you have to be really careful. It is just like, painting exhibit, for example. If you don't have an eye to spot a valuable, rare, collectible painting from a really reputed artist, you will end up buying something which is fake or something which has no value, right? So in NFT also, someone can sell you a zero value NFT that will not make any money for you. So there are games also that are currently in process, and games are launched as NFT. Okay, just to share with you. And Microsoft also uses a platform called Engine to issue NFT for their MVP program. So if you have worked in Microsoft or around it, you know that they have this MVP program, and they issue badge based on your level. And those badges are issued as an NFT on an Engine platform. Those are minted on Engine. So I think NFT is still in infancy, and it's not just about certain set of artworks, but the functionality it brings. And that's something I think creating value from a digital spread is what NFT really stands for.
All right. The final question, which according to you is the most underrated and the most overrated cryptocurrency as of now?
Okay, I think, even if I try to answer that, people can still say, I have a bias against or bias for certain currency. I am a believer in the technology, and no matter what token it is, I'm not calling it currency, if you notice. So I think if I have to answer it nonetheless, I think the most overrated is Bitcoin, question. And the most underrated probably is Solana, I think. Ethereum and Matic are probably in between. And see, I don't believe in the speculative kind of tokens, which, somebody can tweet and then just rally the token 100% in 24 hours. I don't believe in that kind of thing. I mean, it's good to be rich overnight, but it's not a realistic scenario anymore. So if you want to invest, you should invest in what is the scale that technology is bringing in. For example, when the internet started early on, okay, we have this, now nobody remembers to type HTTP or HTTPS. Browser automatically detects it. All you enter is google.com, right? So, but these protocols, they operate behind the browser nonetheless. And there is an entire protocol stack. There is a client server mechanism. There is a request response mechanism, right? So if I were to tell you that when HTTP stack was launched, HTTP stack would issue certain tokens, and these tokens would be traded. And tomorrow, the internet adoption will explode through the roof. And imagine we are still in 90s, okay? Or probably even earlier than that. And I tell you that tomorrow, the entire commerce that you do offline will try to shift online, and there will be everything done online. You can book doctor's appointment, you can have your stuff delivered to you, you can have food delivered to you. Everything is done online. And when I'm saying everything is done online, your HTTP tokens are used for transactions. Would you buy these HTTP tokens for $1? You'd say, no, man, it's not going to happen. So what happened is, in the previous Web 1.0 or 2.0 model, the value actually got accrued on the application layer. HTTP or HTTPS, it's a protocol layer. So value never percolated on the protocol layer. It got accrued on the application layer. So that's why the applications that are built on top of HTTP or HTTP protocol layer, they are the ones who are making money. Facebook, Instagram, Zomato, Swiggy, these are all applications which are built on top of that stack, protocol stack. And they are the ones who are making money. But HTTP and HTTPS, the protocol stacks, these are operating as non-profit entities. What Ethereum is doing is it's transforming that protocol from HTTP, HTTPS to ETH. So Ethereum is the protocol of decentralization. And that is one place where the value will not accrue on application layer, but it will percolate on protocol layer. So that's a fundamental shift that's happening here. So if you are able to see this fundamental shift, you clearly understand, okay, what protocol I want to buy. right? So people give this example of Cardano being technologically superior to Ethereum or Solana being superior to Ethereum. But you have to really understand one thing for very is the network effect and how many people are actually using that. It's as simple as that. Right now, there are probably 4,000, 5,000 odd projects which are running on top of it. And there are not even 10% or 1% of it which are currently active on Cardano because their smart contract ecosystem itself is not live. It will be live in a couple of months, but it's still not live. So if your core is not live, it's like you are delivering me a car, but you are promising me that you will deliver engine in a couple of years. What will I do of that car? Instead, I have a Maruti 800. It has an engine. Okay, it's not a flashy looking, but it gets things done. And then it creates a cash flow for Maruti because more people are buying it. And through that cash, they can evolve and create a better version of a car. And they have a chance to compete against technologically superior manufacturers, right? So that's a fundamental shift that's happening. And I think the problem here is, we have probably 4,000 odd tokens and more token get listed and airdropped every day. So it's most important to understand the technology. What is the fundamental shift? What is changing? What is the scale of it? So if you understand that, you would clearly understand what's underrated and what's overrated.
All right. Thank you, Ameya. That is the conclusion of this interview. It was great interacting with you here at Valuationary.
Good to be here. Thank you so much, Vanil.